Hello and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to welcome in David Hunter to the program, Chief Macro Strategist at Contrarian Macro Advisors with over 5 decades of experience on Wall Street. Prepare for some serious forecasts in this episode as David unpacks his view that the broad market is headed for a blow-off top, resulting in a global bust that will wipe out 80% of the stock market's value. Which assets will survive? Which assets will get slaughtered? And where is the best place to get positioned right now to protect yourself from the carnage he sees ahead? We'll get David's view on gold, silver, the bond market, and so much more, so strap yourselves in for my conversation with David Hunter. David Hunter, great to have you back on Commodity Culture. I want to start off with the Trump administration's tariff policies in what seems to be an ever-shifting landscape of on-again, off-again tariffs, tariff pauses, threats, etc. You wrote recently on X about Trump. I think many had unrealistic views about how fast or easy this would be. He's trying to reverse decades of bad policy and deliberately bad policy from his predecessor. That takes time. I think what he has accomplished in 4 months has been amazing. Expand on that for us. Do you think these policies will ultimately achieve their intended goal in the long run?
Sure. Hi, Jesse. Great to see you. Thanks for having me on. Um, I stand behind what I said. I really think people are unrealistic about and don't really understand what the Trump administration is trying to do, and how difficult that is. Not just tariffs and trade policy, but also with the budget deficit and with Doge, what they're trying to do in terms of bringing government back into a real world efficiency, which they haven't been in for decades. And he's also taking on immigration. Obviously, he's accomplished a lot there. Doing a lot of things on the social side in terms of what had become a kind of off the rails wokeness in this country. And so he's taking on a lot and he's doing a lot all at once. If you look at previous administrations, typically kind of one step at a time. Let's take on this. Maybe we'll do this down the road. He's doing it all quickly because he knows he's got at best 4 years and maybe only 2 years to get a lot of this done. And he's not getting a lot of cooperation from everybody in Washington, to say the least. He's got some loyal people in Congress, but even on the Republican side, there are people that are establishment that do not want change, and they're fighting it. So, I think when you take all of that into account, you have to look and say what he has done so far is amazing. And I think people are underestimating how much more he's going to get done. The tariff thing, for example, obviously we just had this ruling overnight that's, everybody's getting, some people are seeing it as a positive that takes away the tariff threat, which, some on Wall Street don't like. But I think ultimately you're going to find he may win on appeal, and if he doesn't win on appeal, listening to some of his reports, the people that report to him, they're dealing with trade. They have plenty of other avenues to go, and if this does get, if this ruling stands up, I understand what he was trying to do with this, in terms of this being emergency, uh, putting it in that emergency category and trying to get it done that way. And the courts have ruled that this isn't an emergency. Well, they're saying when you look at how many deaths are coming from fentanyl, and you look what that's a deliberate effort on the part of China to push fentanyl into this country and to and obviously Canada and Mexico are the avenues where it's coming. So they can still argue that this is an emergency, and I think have a very good argument, and they seem confident they'll win on appeal. Whether they do or not, there are other avenues. This is not the end of tariffs. There are those on Wall Street. Obviously, the market rallied this morning, thinking, "Oh, that's off the table now." I think Wall Street's wrong. They should be rooting for tariffs, not or at least a tariff strategy. It's what ultimately is the goal of the Trump administration is freer trade, not more, not higher tariffs, not trade wars, but it takes negotiation to get there, and that's what this has been. That's what I think a lot of people do not understand or underestimate in terms of the effort being made. They take it at face value, particularly when you go back to early April and the panic on Wall Street. The funny thing is, he's trying to convince trading partners that he means business. They may not have been so sure he meant business initially, but Wall Street sure thought he meant business and believed at face value that he was going to increase at those levels. And I all along said, just let it play out. This is all negotiation. And that remains my view. I think you will see when this is all said and done that we will have freer trade with many of our trading partners. We will have much more access to some of these foreign markets that we haven't had access to. We've been a big, wide open market, and he came in. He understood it first term, but even more so this time. He came in really understanding that the leverage he has is the fact that everybody needs our market. Not only wants our market, but needs our market. In particular, China, who is obviously the biggest target here. So I think he's, it's the art of the deal. This is who he is. And if anybody underestimates and says we just have to hold out and he'll cave, I don't think they understand how he negotiates. He does not negotiate if he doesn't mean what he's putting up there. He does go to extremes and hopes to move much closer to the middle, but don't underestimate him and think, oh, these are just bluffs, because they are not bluffs. That's why he's such a good negotiator. He knows he knows it doesn't do any good to put something up there if you don't mean business.
And now a quick break to hear from our sponsor, ARC Silver Gold Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1-ounce coins, mint fresh, only $2.47 over spot. Mint Fresh Silver Maple Leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Well, let's talk about the broad market's reaction to Liberation Day and where we've come since, because obviously quite a severe sell-off after the initial tariff salvo was announced. We have since seen quite a recovery from there. What are your thoughts on the initial sell-off, and do you still think we have a ways to go to the upside from here?
I absolutely do. I believe that, and I said at the time, as you probably know, right around the bottom, under 5,000, somewhere between 48 and 4,900. I raised my target to 8,000 from 7,500, which had been raised several months ago. And while everybody else was lowering targets and talking very bearish, I was seeing that sell-off as kind of the refresher, the thing that pulled all the optimism out of the market and basically built a wall of worry that allowed us to have another leg up. So I became even more bullish, and that's still my stance today. We've had a remarkable recovery from that, April low, whatever date that was. We retested. People kept talking about a retest all the way up. And I said we had that retest when we went back to 5,100 after, we rallied for a week or 10 days and then went back. So we've had the retest. I don't think we're going back there. I think we're in the new bull leg, the final bull leg that I think will take us to that 8,000 top. And I have said more than once, even 8,000 may be a conservative number.
Very interesting. I want to shift to gold for a moment here, obviously putting in a very strong performance in the last few years, also one of the few assets that held up rather well in the face of the tariff announcements. It seems like there's a lot of tailwinds working in gold's favor at present. Of course, there's always that talk about gold somehow being reintroduced into the monetary system in one form or another. In the past few years, it's been BRICS, and now there's talk about, perhaps the US will revalue the gold on the Fed's books, currently valued at $42.22. They're going to market to market to improve their balance sheet. We've got talk of Fort Knox. I mean, there's a lot of conversation going on surrounding the gold market. What are your current thoughts when you look at gold?
Yeah, I'm still bullish gold. I raised my target to 4,000 not too long ago. I think back in my last letter. I had raised it from 3,000 to 3,400 last year, and then in my April letter I raised it to 4,000, and I think we'll see that this year. Obviously, gold had a big run. Most recently from the mid 2000s to 3,500, and it's spending some time here in a high level consolidation. You may still have a little bit more to go on that, but it'll stay above 3,000, probably above 3,200, I would guess, and may go slightly below that, and then after that consolidation, which might last another couple weeks or might not. I think we are off to the races again. As you say, there are lots of reasons people have warmed up to gold. Not surprisingly, when the tape is strong in any asset, that momentum pulls people into it, gets people interested. So that's part of it. But along with that is the talk about gold as whether we're I don't believe we're going back on a gold standard. If we are to very very minute piece that might be put in there, and I think it's still years away. It's not imminent. It's not this year. It's not next year. I have, as you know, a forecast of a global bust coming. You're not going to be instituting any kind of discipline into the currency at a time when you need total flexibility to get you out of a bust. So that postpones any possible gold standard type change for at least a couple of years and maybe longer. And even then, I think it's a lot of talk. I think getting there isn't going to be so easy.
And any thoughts on the gold mining sector at present? A lot of people are pointing out that the gold miners are not necessarily performing as they have in previous gold bull cycles. Generally, they are basically a levered play on gold, offering a lot more upside potential. This time around, that has not generally been the case, although we have seen some of the majors start to pick up steam, particularly Agnico Eagle. A lot of people pointing to the developers and even the explorers as offering a pretty good value proposition right now. Do you pay attention to the gold mining space at all? And do you think there's any opportunity there at present?
Yeah, I very much do. I'm a big bull on the miners. I agree they've been disappointing and lagged the metals. Both gold and silver. People are much more negative about silver as a metal, but silver's actually come along. It's pretty much kept pace with gold. Normally, it outpaces gold in a bull market, so that's a little disappointing. But I think that's about to change. So you're going to have both silver and gold, I think, moving up pretty aggressively. And I think the miners have had some headwinds in terms of costs. Trying to work through. Mining is a tough business because you've got it's getting tougher and tougher to find the metal, and so it's more it's more costly to find it now, more costly to mine it. So they've had some of that in terms of the earnings haven't really kept pace with the price of the metal. I think as the metal moves up here, it opens up a lot of room for them to leverage up their earnings, and so I am very bullish. I have targets on the metal ETFs, the mining ETFs that have been long-standing. I have a target on GDX of 65, a target of 100 on GDXJ, which is the junior miners, and on the silver side, 75 for SIL, and 35 for SILJ, which would be almost a triple from here. Um, so, so I obviously have pretty bullish expectations going forward, and I think those targets could be reached this year.
So let's pull on the thread regarding silver for a moment here, because people like to point to all sorts of aspects, that data points that they think makes it seem like silver is undervalued at present, the gold to silver ratio, the fact that it's nowhere near previous all-time highs. Interestingly, both silver's previous all-time highs were very short-lived. It went up to 50 and then completely collapsed after that. Do you think we could see a more sustained price, assuming we can get silver back to the $50 plus range? Do you think we could get there and then keep it there on a more sustained basis?
Yes and no. I do think my target on silver, and it could be this year, is 75. So that's a good run from here, obviously. And I do think that once we get up there, because of a coming global bust, if I'm right that we're heading for something that's worse than 2008-9 in terms of a global economic and financial downturn, I think you could see a very big hit to both gold and silver. Gold might go back to its breakout at 2100, or might at least back to the mid 2000s. So if you go 4000 back to there, that's a pretty good hit. Silver, which is much more economically sensitive, I think would be hit much harder. And so if my 75 is right, it could come all the way back here and probably even all the way back to the low 20s in a global bust. But that being said, on the other side of the bust, and I think a bust lasts no more than a year to 18 months, and markets probably less than that, bear markets. On the other side of the bust, I think the precious metals are going to be huge, huge winners. So I've got a target of 20,000, or forecast at 20,000 for gold out in the early 2030s, and silver something around 500. So I think this is a big bull market that has a long ways to run. But in there, you have to be careful that it's not a straight line and that there is that potential for a pretty big sell off in between. I would look at it as a great opportunity, not as a disappointment.
Right. So I think for most people out there, obviously it's very difficult to time the market or to know exactly when to buy or sell these types of assets. So would you say for your average person out there, holding gold and silver kind of through the bust makes sense? Or would you be trying to sell before the bust occurs? And if so, what are the indicators you'd be watching to let you know that that's coming?
Yeah, I don't provide any, as a macro strategist, I have to stay away from advice or recommendations. But that being said, everybody has to make their own mind up in terms of what kind of risk they want to take on and how risk averse they are and how they handle sell offs, etc. I think emotional reaction is different in different people, so that's an important factor. Um, but all I can say is if silver indeed can go from 75 back to the low 20s, that's an awful lot to give up just because you don't know exactly how to get in and out. I think it's always wise to not be greedy. This is, yes, it's a long secular bull market, but there's a pretty big cyclical bear in there if I'm right about the bust. And gold's not as volatile. So gold, I think, maybe less of a concern that you buy and hold. But with silver, that's a lot of volatility to withstand. And for most people, having watched for 50 years how investors respond psychologically, if you have silver go from 75 to low 20s, it's not like it's going to be easy at that point to buy. So you could get out. I mean, you could get in, then get out at 75 and write it all down. So you have to be really cognizant of who you are. But also on the other side, on the buy and hold, you could hold it all the way down and say, "Yeah, I'm a buy and holder. I'm not. I believe in that long term story." If it goes from 75 to 20, there's a lot of those believers at 75 or who are non-believers at 20, and they sell. We see it all the time. People buy at the highs and sell at the lows. So I'm I've said this about the overall market because I'm calling for an 80% bear after this big run to the top in equities. Um, this is one time. I know the mantra has been in place since the mid '80s. It's time in the market, not timing the market. That's been the key, and that's been so true for those that bought an S&P index or whatever back in the mid '80s and just stayed with it and listened to that advice. They've outdone most people. It's been great advice, or it's been a great way to invest. The problem is we're heading into a very different period here where it may pay to time the market, partly because of that psychology, not so much to try to be a trader or think you're smarter than other people, but because that decline could be so large and psychologically could really beat you up and cause you to do 180-degree wrong turns. You hold at the top and then at the bottom you sell. So I think we are entering a period here in the next 6 9 months where it's going to pay to probably ignore that it's time in the market story and go with timing the market.
What's your view on the bond market at present? Maybe starting with U.S. government bonds. We've obviously seen some turmoil with the long-term bond market rates rising recently to fairly high levels historically. Do you think there's any danger there? What's your general outlook on U.S. government debt, and then any other bond market areas that you'd like to provide your outlook on, whether that's emerging market debt, corporate debt? How do you expect all of that to perform up ahead and through the bust? Yeah.
So I'm a contrarian macro strategist. My company is Contrarian Macro Advisors, so I'm true to that label. I am very contrary right now in terms of bonds. I mean, the vast majority of people are very nervous about the bond market. There's lots of calls for 10-year to go over 5 and 30-year to go much higher than it's been. Um, and there's a lot of bearishness when you look at the measures. It's the kind of sentiment you see at bottoms in markets. So I think we're very much in a bottoming bond market here. And surprisingly, we topped out on rates over a year ago at 5% on the 10-year and a little higher than that on the 30-year. And surprisingly, we're down in 4.5 on the 10-year, and yet people are more bearish than they were then, practically. So I think we are looking at a big turn in rates here. Again, this is very non-consensus, but I do believe we're going to see through this summer and into probably through the balance of this year and into next, maybe much of next, rates coming down. I have said I wouldn't be surprised to see the 10-year down below 3% by fall, and maybe even as low as 2.5. And I wouldn't be surprised to see the 10-year at zero in the bust. In fact, that's my call, is that we'll see a 0% 10-year rate when we get to the bottom of the bust. Part of that is going to be the response to the bust will be massive money printing. So even though they'll also be borrowing, the Treasury will be issuing a lot more debt. The central banks will be buying every bond that's out there and trying to monetize it, trying to get money into the system. So, but that's later. Earlier on, I think the rates drop because I expect the economy to slow. The tariff thing definitely took its toll, and there are people who are thinking, gee, the market's held up here, so I mean the economy's held up here, so maybe it's not going to take its toll. Now, I think we had buying ahead of tariffs. So, you look at short term numbers and you say, the economy's doing okay. But as we move through the summer, I think it'll be more apparent that there was some slowing caused by the tariffs. And some slowing means we should be in negative territory on the economy, I think, this summer. And as that becomes apparent, I think you'll see rates come down.
And any thoughts on other sovereign nations' debt? Japan, obviously, another interesting case where people are sounding the alarm, saying that there could be a meltdown there in the bond market as rates on the 30-year have risen to, I think, levels they haven't been at since 87 or something like that. And then some of the other bonds, I think the 10-year also rising as well, leading some to believe that the Bank of Japan no longer has control. Obviously, they do yield curve control over there. What are your thoughts on the situation in the Japanese bond market? And is there anywhere outside of U.S. government bonds where you'd be looking for opportunity in the bond market today?
So Japan specifically, speaking to that, I've long said Japan's a wild card in the bus because they're pursuing, this yield curve control means they're pursuing a policy that is, first of all, to control yields, you have to print money, right? So ultimately, they are betting on the fact we've heard about yield curve control here, and I laugh at it and say it's not a real theory, because ultimately, you can't control yields because as you print money, ultimately you get what happened in Japan. Inflation starts moving up, demand, the economy starts moving up, demand for money moves up, and you can no longer control it. It gets out of your hands. And then, because there's such lags to the policy, by the time you realize it really, you're in a place where you have to watch things get out of control before you get it back into control. You try, but it takes a lot. So I think there's a lot more to come in Japan. Rates are going to go a lot higher before they roll over. And so there's trouble there. And the problem is, if we hit a bust by late this year, early next, it's going to be at a time when Japan's lost control of its rates and maybe inflation, and so they're not going to have a lot of control over what the world economy is doing to their economy. So they are a wild card. I think they've played a dangerous game for a number of years, decade or more, that is now coming back, and the breakout in rates is what's making people nervous. I would argue that we're not at that break point. As you saw, I backed off. Once they said, "Yeah, we're gonna, we're not gonna push this too far right now." They have some control to kind of manage it in the short run, where you're not going to be. People were saying, "Is the bust now? Is Japan triggering the bust?" I said, "No, you have time, but give it another 6 or 8 months, and things could be a lot dicier." So in Japan's case, yeah, I think it's going to be a problem. I think rates are going to continue to move up as we move through the year. That's very positive for the Japanese yen. You're going to see the yen move up pretty aggressively here, I think, in the next 6 to 9 months. But in terms of it being a bust in Japan, that's next year's story, not this year's. In terms of overall, I think I really am so U.S. centric. I'm not really looking at out of this country, but I will just comment on foreign sovereign bonds from a longer term standpoint. I'm calling for a bust. I don't. I don't think sovereign involuntary sovereign situation is going to be the problem. I don't think you're going to have involuntary debt liquidation in sovereign bonds so much because of the printing press. Most of the countries will be able to handle that this cycle. The bigger problem for sovereign debt, I think, is going to be in the mid 30s. And at that point, we'll have high inflation because of the policies that get implemented to deal with the bust. It will create a big inflation cycle. By the time you get to the mid 30s, right now we have 320 or 330 trillion in global debt, much of that being sovereign. By the time we get to the mid 30s, that will probably be north of 500 trillion, maybe more, and we'll have interest rates in high double-digit territory. That's when things come crashing down. And if you have high inflation along with things starting to unwind, you don't have any control over that because you've lost the printing press. The reason this is not that big collapse that a lot of the Austrian folks, the Peter Schiffs of the world, are calling for a collapse more now or very soon. The reason it's not, in my estimation, is because we will ultimately in this downturn have deflation, and that gives the printing press or the central banks infinite ability to print money. In the next downturn, say mid 30s, sometime in the 2033 to 35 time frame is my estimate. In that period, you'll have high double digit inflation, high double digit interest rates. You won't be able to fund your debt, but you also won't be able to print your way out of it. The printing press will be totally shut down. And that's when you run into the problem. Because, if the countries can't service their debt, that debt is worthless or you're bankrupt and you don't have a printing press to bail you out. That's the one thing that set the sovereign debt apart from corporate debt is you had the printing press. Well, if that's taken out of the picture, then you have a collapse, and that's kind of my estimate for 8 or 10 years from now, not now.
So if you were entering the market, or let's do this. This is the thought experiment I do with guests sometimes. All your assets are gone. You're now, and I give you $100,000, let's just say some arbitrary number. You're entering the market today. Where are you looking to deploy that capital? Because of this coming bust you see, would you be more heavily into cash, short-term T-bills, money market accounts, or obviously you see a lot of upside in the bond market. So would you be mostly allocated to perhaps longer-term government debt? Where would you be allocating capital today if you were entering the market for the first time?
Yeah, I can't answer that question per se because I can't give advice. But what I can say is that people should be aware if I'm right, and again, I'm pretty confident these are high conviction forecasts. If I'm right that we're headed for S&P 8,000, NASDAQ 27,000, Dow 55,000, and Russell 3,300, those are my targets for this year, and probably sooner rather than later, meaning doesn't mean the end of the year, it means probably end of summer or early fall, somewhere in there. Um, doesn't have to, but that could happen that fast. If I'm right on that, those that are so nervous right now need to understand that yes, we're in kind of a funny period where yes, we're within months of maybe the biggest bear market we've had since 1929. At the same time, we're still, 30 or 40%, and in Russell's case, 60% away from 50, 60% away from the top. And those are returns, if you talk about it as 30 to 60%, those are returns that would normally take you, 2, 3, 4 years to get. Yeah, you might get them in the next 6 months. And so you have to be aware that we're in an unusual period where you're going to have very fast returns, very big returns very fast. So it's not as easy to say, well, we're getting close time wise. Maybe you need to get defensive now. Because what I predict is that with a lot of people who are defensive now or get defensive now, will be forced into the market if we're up another 30%. They're going to think they missed it, and people never realize at the top it's not going to be at a top because everybody's aware that things are going to get bad. It's going to be at a top with everybody telling you this thing has a long ways to run. They're going to be telling you that the cycle's just beginning. There's another 3 years to go. And you're going to sit there and say, I can't afford to miss this. It's too strong. Psychology will pull you back in. So if you get out too early, you may be forced back in at the very time when you should be getting defensive. So I just put that out there as a thought process for people to go through in a period like this. Is don't be so, it's just different. It's not, and you're going to have plenty of advice from people. The same people that are going to be telling you to be defensive now are going to be the people telling you to get in at the top. So you just have to be careful. I use the term ignore the noise, meaning there's a lot of advice that gets provided on Wall Street and elsewhere, and certainly on social media these days. And just understand that an awful lot of that will be proven wrong, as it always is. I'm a contrarian for a reason. Psychology has most people bullish at maximum bullish at the top and maximum bearish at the bottom, as we saw back in early April.
Yeah, very well said. And I love your focus on investor psychology. That's an aspect that not enough people pay attention to, and something that very much affects individual investors in ways that they might not expect. A lot of people think they're very resilient to risk until they see their portfolio get cut in half. David, this has been a fantastic conversation. Before I let you go, tell us about Contrarian Macro Advisors, how people can subscribe to that service and what it's all about.
Sure. My two places I communicate, and I communicate to both institutions and retail, is on the one hand, I'm on X or Twitter every day. I've got to go through a little bit of an explanation here in terms of because I'm getting a lot of feedback recently of people who I often get people who will say, "Gee, I put something out," and they'll go, "I haven't seen you in months. You're finally saying something. Where have you been?" And I'll go, "Just last week I had 100 replies. I was on here every day with dozens of replies." Um, and I find now what it is unless you have your settings set to being notified for notified for both. Say you click on posts and replies. You don't see it. You might see my original post, but I do very few original posts now. I mostly reply to other people with the expectation that people are seeing those replies, and it's kind of how I educate them, the retail public. But I'm also finding, because this has been a conversation in recent days, that for some reason X doesn't allow when you click on that bell, when you go to my profile page and click on the bell at the top, which is where you would say you want to see my stuff. It does not provide for. There's no option to click on select all or select posts and replies. The only place that's offered is on your cell phone. If you do it on your cell phone, that option shows up. So for all those people that are on X through their computer, they're not being given that option. So they're missing replies because they don't have an option to select it. Some people are telling me they go to my profile page every day and they kind of wade through my replies every day to see what I've done that day. But if you want live notifications of replies, because I'm replying all day, you've got to go on your cell phone, I guess, and select that. I never knew that myself, but I've been told that anyway. So that's I am on X every day pretty much, and then secondly, and through X you can access these kind of interviews that I've the YouTube interviews, and then I do publish a quarterly investment letter that is available by subscription, which means that it comes with a cost. If people are at all interested in it or think they might be interested in it, all they have to do is direct message me on X, and I will provide details to you.
Great. Well, I'll put a link in the description below to your X profile. Thank you once again, David. Fantastic conversation as always, and it's been a blast.
Yeah, thanks, Jesse.
And thank you for joining us today. This episode is sponsored by ARC Silver, Gold, Osmium. Take advantage of their specials right now. Silver Kangaroos 2023 1-ounce silver coins, only $2.47 over spot. Silver Maple Leafs 2025 coins, only $2.87 over spot. While supplies last. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.